Hello and welcome everyone. This is Sean Howell with E-Trade, and the topic for this video is going to be iron condors on the S&P 500. This is going to be a little bit of a hybrid presentation in which I'm teaching about the unique characteristics of index options, and we're going to combine that unique vehicle with sort of a unique strategy, which is going to be the iron condor. I think as I go through this, you'll understand why it is that index options are sort of well qualified for utilizing in an iron condor setup. Now, of course, you can use them for many other things, or you don't have to use index options on iron condors, but I think you'll understand why these two why people look to index options when they're looking at iron condors. And that is really what the goal is here, is I want you to understand index options, and I want you to understand how to trade a range-bound market. Currently, we're having a lot of volatility in the market. We're seeing big whipsaws to the upside and to the downside. But when you have a market like this where you have big whipsaws and you're not so much trending, and you're wondering, well, what kind of a strategy can I turn to when we're range bound or we're whipsawing back and forth with higher volatility? You may be interested in looking at the iron condor, and I think again you'll see why as I go through this. So let's keep plugging along here. Well, the agenda for this session is going to be, what is an index? You probably are aware of what an index is already, but I want to be sure that you fully understand those here. The characteristics of S&P 500 options, which are a product of the Chicago Board Options Exchange. Those are the SPX options. And then I'll get into talking about iron condors. We'll go through a variety of scenarios and outcomes, and then how to manage the iron condor position utilizing SPX options as well. So let's talk about indices first of all. Well, what are they? You're probably familiar with indices like the Dow Jones Industrial Average, NASDAQ 100, so on and so forth. Well, what there really are is a way for us to measure how stocks that are similar in a certain respect. So, for example, the Dow Jones Industrial Average Index is an index of just 30 companies, and they're giant companies, but what they have in common is two things. One, they're giant, and two, they're industrial. So you've got stocks in there like 3M and Boeing. They're both giants, and they're both industrial. So that sort of allows us to observe the price action of the 30 largest industrial-based stocks. And then take the NASDAQ 100. That's different than the overall NASDAQ, but the NASDAQ 100 is the largest 100 stocks that trade on the NASDAQ, and that would be things like Apple and Intel and Facebook. It tends to sort of be a little bit more along the lines of growth and technology, if you will. And then the Russell 2000 index is going to be 2,000 small caps. So to look at that index, you'd be looking at smaller companies. In fact, many of those companies you've probably never heard of. And then finally, we've got the Standard & Poor's 500, which is a large cap index, and as you can probably already guess, it contains 500 stocks, 500 of the largest publicly traded stocks that we have. In fact, you're probably also picking up that the stocks that are in the S&P 500, you're also going to find in the Dow Jones Industrial Average and also in the NASDAQ 100. So there's going to be some overlap there. The thing that I find very interesting about the S&P 500 is that if you are looking at the S&P 500, you're generally looking at about 80 cents of every $1 that is invested in the stock market. So when I'm trying to understand what, quote, the market is doing, and I just have to look at one index, I don't usually look to the Dow Jones Industrial Average. I look at the S&P 500 because of that 80 cents on the dollar representation. As such, it's my go-to to understand what the market is doing and what your average person's portfolio is doing. Now, of course, if you have concentrations in things like technology, then it may not be as appropriate of an index for you to take a look at. Okay, let's keep plugging along here. How do people trade the S&P 500? Well, I've seen people go out and buy shares. Let's say you've got a $100,000 portfolio, and you decide you want that portfolio to sort of replicate the S&P 500, you may decide to go and put, $500 of that $100,000 into each individual component of the S&P 500, or I should say the top 100 or the top 200. I've seen people go and build little mini S&P portfolios within their own portfolio. So you could do it with shares, I suppose. It'd be rather cumbersome. But with commissions being to zero right now, it's just, I guess, going to be time here. But there's other ways that are I think much simpler. One is you can utilize an S&P 500 index mutual fund. Obviously, you'd want to take a look at the fees for doing such a thing. There's exchange-traded funds and exchange-traded notes that also are designed to replicate the S&P 500. Again, you'd want to take a look at the fees associated with those. The difference between an exchange-traded fund versus an exchange-traded note, the exchange-traded fund would actually be backed up by the actual shares of the S&P 500, whereas the exchange-traded note is going to be backed up by the faith and credit of the issuer of the exchange-traded note. So different things, but exchange-traded notes allow people to do things like 2x and 3x of an index, or an inverse 2x and 3x. So people that are after that kind of leverage or that kind of inverse relationship often will turn to an option on an ETF, since you can buy calls and puts on the index ETF as well. And that's what we see a lot of people do. But something that I find not all retail investors are familiar with is that there are actually options on the index itself. People are usually familiar about the ETFs and the options on the ETF, but not necessarily the options on the index itself. And that's what I'll be talking about here as we get into iron condors. So options on the Chicago Board Options Exchange S&P 500 Index trade under the symbols, plural, SPX, SPXW, that W there indicates weekly, and then the XSP, which is going to be the mini one. Now, the SPX and the SPXW are full-size contracts, and these are very often used for institutions, but retail traders use them as well. I do use them from time to time. But the XSP, which is going to be the mini, the 1/10 of the SPX, has sort of been designed by size for the retail investor. So keep that in mind. You've got access to both if you choose to trade one over the other. So let's talk about the pros and cons of trading index options, and I'll go into further detail in the next slide here. But one of the pros is that index options are European style. Now, European versus American style has nothing to do with continents whatsoever. American style options, which pretty much all equity options are, can be exercised or assigned at any time. Now, of course, they're tradable, so don't confuse being tradable versus being exercised and assigned. American style can be exercised, assigned, and of course traded as long as the market is open. Whereas European style cannot be exercised or assigned until they expire, or at expiration, I should say. So there's no early assignment. Now, that can be a pro if you were trying to avoid early assignment. It simply cannot happen with an index option. Now, again, don't confuse assignment and exercise with tradable. Index options are still highly liquid. In fact, the SPX option, besides its liquidity, it also has an extended trading time. It trades for another 15 minutes, provided it is not expiring here. Those are some of the details that I'll cover as we get a little bit further in. Well, another thing, bullet point number 2, is that they settle up in cash. I'll explain that further, but that's also very clean. You'll see what I mean. It's a pure index play. You're not messing around with any shares or anything. Look, if the index is going up and you own a call, it's going up. There's nothing else that's going on. You're not dealing with analyst recommendations. You're not dealing with a CNBC or Bloomberg commentator. It's a pure index play. And let's face it, it takes a lot to move an index, and it doesn't take nearly as much to move an individual stock. There's a tax treatment, which I'll mention here on my next slide. If you're using an SPX contract, because of its size, basically the ETF that's out there for the S&P 500, speaking specifically to the SPY, is about approximately 1/10 the size of the SPX. So if you're trying to keep an eye on the fees that you're generating, if you typically do 10 SPY that would be the equivalent of 1 SPX. Now again, they're different vehicles, but if you are trying to play the index, this just gives you more options, not to be facetious about that. And then the last point here is that with index options, of course, the indices themselves are part of the circuit breaker mechanism. If the markets were to drop too much or move too much in either direction, then what happens is these circuit breakers kick in. And these circuit breakers were really designed around some of the big collapses that we saw in the latter part of the 80s, and of course that we saw during the dot-com bust and then also during the credit crisis. So they're in place for the markets to basically shut down for sometimes briefly, sometimes longer term, for everybody to sort of cool their jets and then come back, so that we're not seeing dramatic, unreasonable market moves to the upside or downside. What about some of the downsides? Well, one of the downsides is that pretty much the index options are traded by institutional participants. So you are not the sharpest tool in the shed when it comes to trading against institutions. They have more money, more expertise, more access to things. So you are maybe the counterparty to them. So keep in mind that you're not competing with other just retail investors. You're competing against the big boys and girls, the institutions out there. The bid-ask spread tends to be pretty large on index options. That doesn't mean that you can't get in the middle. You can't get your executions at the midpoint. Just know that they tend to be bigger, larger on the bid-ask spread. They're a little bit more complex. I'll talk about that in a minute too. And the fourth point here, next day gap risk, that's part of that complexity. That gap risk is only on the AM settled contracts. Again, I'll explain that in the next slide. And then there are premium differences between the index and the index ETFs as well. The index ETFs tend to have a slightly higher premium, and that is because they are American style. So that gives people more options to do things in the interim. And then also one of the downsides, it's the same thing as the upside. European style, there's no early exercise. So sometimes when the gaps with deep in the money options are kind of so extreme that you can't even get the intrinsic value for an option. If you cannot get the intrinsic value, if it's American style, well, you can simply exercise it and go through the exercise and then the selling of the underlying asset that you've brought into the account, and you can capture the intrinsic value. So that's sort of a splitting hair on that one, but again, there is no early exercise, so it's just something to be aware of here. Okay, let's get into the characteristics of those SPX options, because now I want to get down to the nitty-gritty here a little bit of the SPX index options. Okay, so something that you've, I'm sure, learned is that a contract equals 100 shares. Well, that's not the case of an index option like the SPX. There's no shares. There are no shares to trade, because what would you take physical delivery of? Would you take physical delivery of 500 fractional shares of the S&P 500? It just doesn't work out. But instead of it being shares, the contract size is a multiplier. That's all. It's still 100. It's a 100 multiplier, not shares. Okay, so again, one contract does equal 100, but it's a 100 multiplier and not 100 shares. And I'll explain that as I get into an example here. It is cash versus physical settlement. Again, there will be no settlement in shares. You will pay or receive the in-the-money amount times the multiplier, which is 100, times the number of contracts. So let's take an example here. Let's say that you were looking at an index that is trading at $990, and you're bullish on that index. So you buy one contract of the indices 1,000 strike price, and that's going to be a call option. Sure enough, at expiration, the index has gone from 990 to 1,000, and now it's at 1,010. At expiration, that index option, that call option, which is a 1,000, is in the money by 10 points. Great. So you get 10 points for share, but wait, there's no shares. It's a multiplier. So you have one contract, and that contract is a 100 multiplier. It's in the money by $10. So simply, it's 10 by $100. You get paid $1,000. If that was 5 contracts, you'd get paid $5,000. It's as simple as that. If it went in the money, if that index reached at expiration 1,001, okay, it's in the money by $1. You have one contract times the multiplier. There you go. There's your $100. If the index at expiration was $999.99 and you have the $1,000 call option, well, that call option is now out the money at expiration. Therefore, there's no in the money amount. Therefore, you don't get paid any money at all. It simply expires worthless. So hopefully that explains the cash versus physical. Now, the European style versus American, I think I covered that already, but really it just means there is no early exercise or assignment risk. Again, don't confuse the assignment or the exercise with your ability to trade in and out of these vehicles. Now, when you've got an AM versus a PM, now generally with the SPX options, the monthly expirations are sort of old school. And old school is they have an AM settlement. An AM settlement means that the monthly SPX options will generally stop trading Thursday at market close. Again, they'll stop trading at Thursday at market close. People will assume that wherever the closing price was of the S&P 500 is going to be the price that determines if they are in the money or out the money. Well, that's not the case for the AM settled. It is the next morning when the S&P 500 opens, and I'm not talking about the index. I'm talking about the 500 companies that make up the S&P 500. When they all open, their value is then tabulated, and that is called a set value. That set value will determine, was your option in the money or out the money? If it was in the money, that will then determine how much money you will be receiving. Or if you're on the other side of that transaction, if you were short that call or short that put, that will determine how much money you would be paying out versus getting if you were on the long side. So the AM can be a little bit complex. Now, the PM, on the other hand, is exactly as what you would expect. If you have an option that an SPX option that expires Friday afternoon, whatever the closing value was of the S&P 500, that is going to be the value that determines if you are in the money or out the money. So that's one of the unique things as well. But I get it; it can be a little bit complex. And I've got another slide here that'll the next one that'll help you to you print it out and keep this in mind. Okay, now another unique thing, and as a broker, I can get a little bit into this, but not very much. And this is a characteristic. So this is not tax advice. This is simply a characteristic of these vehicles, is how they're treated from a tax perspective. So Section 1256 of the tax code, I certainly encourage you to discuss this with your advisor, with your tax advisor, that is that 60% will be taxed as if they were long-term gains or losses, and 40%. So what that means is that there's not a holding period here that is going to determine the tax rate. If you were in on Wednesday and out on Friday and you had a gain, that gain is going to be 60% of that gain would be looked at as long-term, 40% would be looked at as short-term. If you're in and out and it's in for a year and a half, and by the way, these options do go out 2 or 3 years, so you can take longer positions here if you wanted. Again, it's that 60-40 tax treatment. So I encourage you to explore this with your tax advisor to ensure that this is going to be applicable to you as well. But that is one of the characteristics here. So if you go to eTrade.com, I want to be sure that you understand the differences between these two. If you go to just simply eTrade.com, which is what I've done here, go to the Options tab and then type in SPX. You're going to see this little note that pops up that says, please note there are important differences between the SPX and the SPXW. That would be the weekly. Learn more. If you click the Learn More, you're going to get that information that's down on the bottom that talks about how the SPX options work with the AM versus the PM settlement. And then also, if you take a look at the details here that I've outlined in purple, I'll get that to fire up again. If you take a look at that, that will also indicate this is cash settlement. If you ever get confused to cash settlement versus physical settlement, or what each contract represents, like the multiplier. Okay. So that's eTrade.com. And this is probably a nice reference point to go ahead and take a screenshot of, or if you wanted to print this out. as well, and this is provided to us by our friends over at the Chicago Board Options Exchange. And this is basically a table that outlines the differences between the SPX weekly, the end of the month, and the minis. And then, of course, also compares and contrasts those products to the SPY product, which is not Chicago Board Options Exchange. But take a look under the settlement type where it says cash for the S&P style options, and then physical ETF for the SPY. And then also you have exercise style. So hopefully that can help you keep everything in order here. Okay, so hopefully now we understand about the SPX options. Now, how does that play into an iron condor? So let's get into that part here. Okay, what is an iron condor? Well, first of all, it's a delta neutral strategy. And what delta neutral means is that you do not have an opinion on the market's direction. Hey, it could go up, it could go down. So an iron condor is a go-to strategy for when the markets seem to be range-bound, or you're not seeing a trend, you're just not able to come up with a conclusion on what direction it's going to go. It's defined risk, which means that down to the penny, you can factor in how much money you could lose, but you could also factor in how much money you can make. So it is a defined trade. And you are going to be assuming that a stock, you can do this on a stock, but remember, stocks are American style. You could do it on an ETF. Most ETFs are also American style. Or you can do it on an index. And in this case, we're talking about the SPX, or the S&P 500 index, and the SPX, or its brethren of options. But what you're saying here is that I think this thing is going to remain within a specific support or resistance channel. If you're not familiar with those terms, I do encourage you to get up to speed on some of the basic technical analysis terms. But support is sort of a former buying point, what we would consider to be the floor, and the resistance would be a former selling point, what we would really call a ceiling, if you will, and the stock is in between, and I'll show you this in a moment. So the second bullet point, it has 4 legs. So it's a 4-leg option strategy, and you're combining 2 out-of-the-money credit spreads. I'll show you what those look like. But the short call is going to be a vertical spread that's placed above resistance. Basically, what you were saying with this is, hey, I don't think the stock is going to go above resistance, or the ceiling that you have identified in a chart. As such, you were going to sell a call option up there and bring in money. And you're comfortable selling that call option up there and collecting that money because you're saying, I don't think it's going up that far. But just in case you're wrong, you're going to take some of the money that you bring in from selling that call, and you're going to buy a plan B that you hope you don't need to use. And again, when I show this visually, I think it'll help out quite a bit. And you're going to do the same thing down there at that floor or that support level, where you're going to sell a put and you're going to bring in the money because you're saying, I'm not thinking it's going to go down that low, so I may as well collect the money at the level that I don't think the stock is going to be able to go down that low or below that level. But in case I'm wrong, I'm going to take some of the money that I'm bringing in and I'm going to buy a put option as well. So you've got a total of 4 legs on that. 2 of those legs are short, 2 of those legs are long, 2 of those are call transactions, 2 of those are put transactions. Third bullet point. Iron condors are typically created using technical analysis. So they're typically, you start with a chart. You don't always have to. I will be teaching a session on how to use statistical modeling instead of technical analysis. But typically created using charts to determine the price range, or that statistical model that uses theoretical probabilities, or a combination of both. For the sake of sort of driving home the concepts today, I will be using a technical analysis example as I get to the scenarios here. And then the last point, index options are often used for iron condors since they are European style. So they're easy to put on for the most part, but people will stress out on American style iron condors because they're worried about, oh no, it's gone up too far, I'm going to get assigned. Oh no, it's gone down too low, I'm going to get assigned. Since you can't be assigned on an SPX option, it doesn't really matter what it does in between putting the trade on and expiration. What matters is where it's at in expiration, and at that point in time, it would be settled up in cash. Okay, so let's talk about some pros and cons of this strategy. One of the pros is that You will profit if the index stays within a range. It could go up, down, or sideways as long as it stays within the range. And the nice thing about this is you get to determine that range. If, let's say, you're looking at a stock and you identify resistance at the stock is at 100, and let's say you identify resistance at 105 and you identify support at 95. Well, great. That may be what you choose, but maybe you're afraid to be that close, so you decide to utilize a point like 107 and maybe down at 93. You get to decide that range. And the tighter the range, the more money you will be able to produce as a credit, but also, as I like to say, you are closer to the flame because you are trying to build positions that will avoid the price movement. Second bullet point, it's defined risk down to the penny. You can factor in how much you could lose, how much you could make, but we can also use some statistical modeling to factor in what the probability is that we could either get touched at the high point or touched at the low point. Third bullet point, cash credit. So you get paid up front, and on the back end, it's cash settled. So it's money in and out. What happens sometimes when people are taking on obligations with stock, with American style stock or ETFs, is that all of a sudden they've been assigned shares and they start getting fancy with it. Well, now that I've been assigned shares, I'm going to write covered calls against that. This is nice. This is pure. It's money in, money out. That's it. Last bullet point for pros, no risk of early assignment. So that also is in line with the SPX options. If you were to do this with American style, yeah, there is the risk of early assignment. There's also the risk of whipsaw early assignment where you could get dinged both on the upside and the downside. And I'll visualize that for you here in a moment. What are some of the downsides? Well, you won't get rich on this because you have limited upside potential. Usually speaking, your risk is greater than your reward. If I'm doing an iron condor and there's, let's say, $1,000 on the line, usually that iron condor would look something like I am risking $650 to try to make $350, or I'm risking $850 to try to make $150. It does not usually look the other way around. I am risking $150 to make $850. That's just not the nature of what we're building here. They tend to appear in low volatility environments. That's not the case this week, but usually in lower volatility environments are indicative of a market that's just sort of stagnating, going sideways. You've got 4 legs, so that means you're going to have 4 times the number of contracts, and that means you're going to have greater fees. So that's just something else to keep in mind. Of course, another thing to keep in mind is just how much option commissions have come down in the past couple of months, certainly past couple of years, and certainly the past couple of decades. But there are still fees associated with it, so I don't want to just roll over that. They're slow to produce returns, right? You put these things on, and it takes a while for them to show some signs of profitability, and that's because you're benefiting from time decay. You're hopefully benefiting from a contraction of volatility. Volatility contractions will benefit the trade. Expansions will hurt the trade. And again, you're just waiting out to see if the stock can stay within the range here. And then also you've got bid-ask spread to deal with whenever you're trading options. But because the SPX tends to have a little bit wider bid-ask spreads, and because you're dealing with 4 different transactions when you're building this thing, well, it's really one transaction, but it's 4 pieces of that transaction. Each one of those pieces, you'd be dealing with a bid-ask spread. You got to work around that too. Okay, let's go ahead and set up one now. So here's the Iron Condor setup, and I'm looking at a stock. Of course, I'm the one that gets to design the slides, so I've got this thing all over the place. But if I were to say to someone, where's this thing going to go next? I think they'd be a little bit hard-pressed to pick a direction and then put their own money down on that. But what I see in the setup here that I built is I see, of course, current price at 210, so we're kind of right in the middle of a range. And that range I am identifying with resistance at 213, and that's about 1.5% away from the current price. And I'm also identifying support down there at about 207. So yes, I built this perfectly so that we've got the resistance and the support that are both 1.5% away. Don't expect it to look this way all the time, but again, I want to set up a really clean example. So if I'm looking at this, and if all I know how to do is buy calls and buy puts, or sell calls and sell puts, I'd be pretty hard pressed to find a strategy that I would be comfortable with this kind of chart setup. So here's what we're going to do. We're going to create an iron condor, and you would say that you are writing or selling the iron condor. And here's how we're going to do it. We've got the current price at 210. I'm going to sell the 30-day 213 call for 95 cents. And at the same time, I'm going to buy the 30-day, same amount of time, 214 call for 70 cents. Now let me walk you through that real quick. I'm selling the 213 call because that is where I believe the stock is going to encounter resistance, or it's going to be the ceiling. It will not be going above that for the next 30 days. And I picked 30 days here just to give you a very generic example here. If I could do this for, let's say, 42 days, that would be even better. But the longer the period of time that I can build an iron condor, the more credit I'm going to receive by doing that iron condor, but also the more time I give it, the more things that can come into it. We could have earnings, we could have analyst upgrades, we could have some sort of a global situation, pandemic, we could have things coming out of Washington, we could have things coming out of North Korea, so on and so forth. So I'm selling the 213 and I'm bringing in 95 cents per share, or $95 per contract. I'll speak in contract terms. So I'm bringing in $95. It'd be great if I could keep that $95 and not have to do the next step. But if I just sell a call, I am technically naked. I have unlimited risk. So instead of having unlimited risk, we're going to take some of the $95 and we're going to buy ourselves an exit plan, or a plan B in case things don't go the way that we hope they will. And we're going to buy that 214 call, and we're going to give back $70 of the 95 we brought in. But we brought in 95, we gave back 70, that left us with $25 in the account. Okay, we've got the call side, the call wing of the iron condor on. Let's go ahead and put the other wing on. We're going to sell the 30-day 207 put. We're going to sell that for $1.85, or $185. And then again, to the downside, since we want to protect it, we need a plan B for the iron condor. So we're going to buy the 30-day 206 for $1.60. So again, we brought in $185. We could just do that. Now, because it's a put, you do have limited downside, but it could go all the way down to zero. Now, granted, if this is an index option, the indices going all the way down to zero would mean we have many other things to worry about besides our money, if that was the case. So you don't have to buy the long put to protect the position. But again, to make it an iron condor, then you would go ahead and buy that. Now, the distance that you set these, the width, that's entirely up to you. I've made this balanced. So I've got the 207 put, and that is at the support level that I believe the stock is not going to get below. And in case I'm wrong, I've got the 206 put to protect me there. So I've got $1 risk on the upside and $1 risk on the downside. Let's walk through how this looks. Now, we have brought a total net credit in of $25 or 25 cents per share, 25 per contract for the call wing, and 25 per contract for the put wing. That gives me $50 total contract credit. Now, the question is, will I keep all that credit? Will I keep some of that credit? Will I give it back? Will I give back more of that? Where are we at here? So let's walk through the P&L here. The total credit is $50 a contract, or on a per share basis, 50 cents. The maximum gain is that $50 contract, and that will happen at expiration when the stock is less than 213. Again, staying within the body of the iron condor, below resistance, or greater than 207, or above support. Again, I've defined my range. As long as it is less than 213 or greater than 207 on day 30 when this thing expires, awesome. I will walk away with my full $50. I will not have to do anything. What is the risk? Well, the risk is the width of the spread, which is $1. Now remember, there's a $1 spread on the top, that's the call spread, and a $1 spread on the bottom, which is the put spread. So am I doing my math wrong here? Shouldn't it be the width of the spread on each side for a $2 risk? And the answer is no, because this is an index option and because there is no early assignment. At expiration is what counts, or what matters to determine our profitability or lack thereof. At expiration, it can't be more than one place at one time. So worst case scenario, it's either up above the call spread or it's down below the put spread, but it can't be two places at one time at expiration. So the risk is the width of the spread of just one side of it. They're equal, minus the credit, which was 50 cents, which means I've got 50 cents worth of risk per share, or $50 for a one contract position. That's my maximum loss of $50, and that will happen at expiration if the stock is over 214, that's over our red line there on the call wing, or below 206, that's below the red line for our put wing. And obviously that's what we're hoping is not going to happen, but that's why we built in sort of those plan Bs. And our break-even points are at 213.5 and 206.5. So you pretty much see what you want. Now that you've got the Iron Condor on and it's on an index option, you can really go get on the cruise ship for the next 31 days if you want, because this thing is going to take care of itself because it's cash settled, right? It's either going to, on day 30, be right where you hope it is, which is between these wings, and it expires worthless, and you keep the $50, or it's to the upside, and you give upside like way above the upside, greater than 214, and you give back the $50, and then you give back another $50 of your hard-earned money, or it's going to be below the 206, where again you give back the $50 and you give back $50 more. That's it. So it can really only be one of three things, or I guess it could be in between two. But let's walk through those. Scenario one. This is what you want to see. Over 30 days, the stock just does nothing. It just sort of moves around within that range. And on day 30, it closes at 208.5. All four legs of your Iron Condor expire worthless. And when they expire worthless, that's what you wanted, right? And that means the $50 per contract remains in your account. That money's been in your account for the past 30 days. You could spend it if you want, but now it's still in your account, but it's not encumbered by any obligations whatsoever. So go pay it. Now remember, it's a taxable thing. If you did this in a taxable account, it's a taxable thing. But again, remember that 60-40 tax treatment. If you did this in your retirement account, and you can, I do these in my retirement account all the time. Provided you are a level 3 options trader, you can do these, and you can do them in your retirement account because the risk is defined. It is not, you're not naked. You're not exposing your account to any risk that is greater than what you can afford to lose from an asset perspective. Okay, scenario one. Scenario two. A little bit more complex. Over 30 days, the stock slowly climbs higher to 213.3. This is not where you want it to be. You want it to be below 213. An hour before the market closes, the day prior to expiration, and you're scratching your head. Do we have a problem here? Kind of, a little bit. And the problem is not the put spread. The put spread down there at the support level, that should expire worthless, right? We've got an hour and a day to trade. It's the 213 call that's the problem, because it is in the money by 30 cents. And because it's in the money by 30 cents, this would mean that at expiration, you'd end up paying out the in the money amount, which again is not a problem. But if you're thinking to yourself, whoops, we went through the ceiling. Tomorrow, I fear now that it's through the ceiling, it's going to keep rallying higher. So you decide you're ready to close it out. Now remember, this has nothing to do with exercise and assign. This has to do with you trading out of the position. So the 213 call is in the money by 30 cents. You go and look at the ask price, and the ask price is 35 cents. Why is it 35 cents and not 30? Because the market maker is not going to do the transaction for its true value. They need to make a little bit of profit for themselves. So that's what the additional nickel has been built in for, but you're fine with that. So you're going to buy the call to close. You're going to give back $35 per contract. Well, how did the profit and loss work out for this trade? Even though you were wrong and that ceiling did not hold back the stock, it broke through that because you reacted quickly and you bought it back for $35. That was $50 that you brought in and you just gave back $35. And essentially the trade is closed out. Now, granted, we still have that put spread down at the bottom, but that should expire. It's so far away. But if you pretty much have closed the trade out for $35, yeah, you made $15. It's not the worst ending is what I'm getting at in this case. So you can manage these as we get, well, into the trade or closer to expiration here. Don't think that you can't. A lot of people don't. They'll treat them as binary, but you certainly can. Scenario 3, this is maximum loss. 30 days, the price falls hard, and 30 days later it closes at 204. Well, the call spread expires worthless, but I mean, who cares, right? Yeah, you were successful on the call spread, but who cares? Because the 207 put is in the money, and so is the 206 put. And that means that the 207 put gets assigned, and the 206 put gets exercised. And remember, these are cash assignments. So we call this same-day substitution where you've got money coming in, money going out. Well, how did it work out? Now, we could do the whole math of the index being down at 204, but it's simpler to just say, well, you're clearly at maximum loss. What was maximum loss? Maximum loss was you giving back $50 per contract and then giving back another $50. So you lost $50. That's it. And by the way, the exercise and assignment, there's no transaction fees to do that. So yeah, this is as bad as it gets. Now, obviously I'm talking in a one contract position. If this was 10 contracts or 100 contracts, it would hurt more, but it's still a defined risk trade in that the most you could lose on a per contract basis was $50, and this is that very example of what that would look like. That's scenario 3, and that's it. So very they're sometimes complex to put on when you're thinking about all the moving parts, but really once they're on, especially with an index option, you can kind of sit back and go do your thing and wait to see where this thing ends up, or you can manage it on the fly as well. Let's talk about managing the position. Ideally, they don't require any management because it just works out in your favor and all options will expire worthless at expiration. That's what you want. However, if price breaks through or starts to rush up and you feel that your support level or resistance level is being threatened, then think about closing whatever side is being threatened. And we talked about that, I think, in scenario number 2 here. But yeah, you can manage it. There's nothing wrong with that. And also, time's on your side with iron condors. If it's not moving, that's what you want. Sometimes we get so programmed to, I want the market to move, go this direction, go that direction. No, you don't want any movement here. In fact, you don't want any movement. You want the volatility to contract. You want the volatility to come together a little bit here. You want it to see a reduction in that because the reduction will benefit the overall trade. And then the last point here is index iron condors can be treated as binary positions. What I mean by binary is, hey, I'm not going to do anything between now and expiration in a week, 2 weeks, 2 months, 3 months, however long. You can treat them as binary positions and they're simply left alone until expiration. And at expiration, you're going to either walk away with whatever the maximum risk amount was, or the max, I should say not max risk, max gain, the max loss, or something in between. You'll know what it is when you get there. And I've utilized these before when I've been on vacation, cruises or overseas, and I don't want to get up in the middle of the night to do any trading at all. I can set them and forget them, but I'll also manage them if I've got access to. So what are the takeaways? These are level 3 strategies. So if you are currently looking to trade these in an account that you do not have any options approval, you'll just need to do options approval on that account and request a level 3 because you're doing spreads. Essentially, this is 2 kinds of spreads combined. If you're level 2 and you want to upgrade, then just do the options upgrade there. And then also, you can practice trading this. You can go to etrade.com, go to the complete view on the right-hand side. You're going to see Power eTrade, which is great. Right below there is the Power eTrade Simulator, which we call paper trading in that account. You can trade options on that. You already have your levels there. And there's $100,000 of play money and simulated data there. So you can go in and mock up an iron condor, maybe using support and resistance. Again, in the future, I'll talk about how to utilize a statistical model as well. But hopefully that gets you right where you need to be to understand how to trade some index options and how those index options may feed into an iron condor strategy. For eTrade, this has been Sean Howell. I hope you have enjoyed the video. Thanks again. Bye-bye.